So when you log into TradeMachine, this is what you see, and I'll add this little zoomed out. So I'll zoom in a little bit here. So each one of these is a separately back-tested strategy that uses a different combination of earnings events, of technical conditions, and of the actual options that you're trading. And they've been optimized for what stops and limits, the days to expiration for the trade, if it's simply a call or a call spread or a put spread, or if it's using a diagonal across different timelines. So we've run hundreds of thousands of different combinations for each one of these strategies to try to find the optimal combination. And we've tested so many strategies, 30 or 40 different strategies that didn't have edge that we just never included in the product because they weren't helping. They weren't going to help anyone. So the strategies that are here, for something to show up on this screen, it needs to have a winning track record over multiple time frames, like 1 year, 2 year, 3 year, 5 year. It needs to have an average trade return that's solidly positive. It's a little different for each individual strategy. It needs to have a total trade return that's positive. And it needs to have more than just a single win. It needs to have a decent track record of trades with more wins and losses. And so this is a very highly curated list of trades that are being presented. And each one of these strategies has a different philosophy, a different reason that it's there, different set of market conditions that causes it to trigger, and many times different actual securities that are being traded, different options, different months, different combinations of calls and puts. For any one of these, there's a little question mark. If you click the question mark, you're going to get either an article or a video walkthrough. Oftentimes the video walkthrough is right inside the page. When you click it, you're going to see a detailed breakdown of what the strategy is, why we created it, how it compares to the market as a whole, how it compares to just like if you're buying a call, hey, look, if you just bought a call for this big basket of stocks, how would it have done? If you buy it using this technical setup and these other triggers, look how much better it does. So we can actually kind of walk you through the process that we used in order to come up with these. So each one of these has a little breakdown, and you can sort, with these symbols if you'd like to, or by returns. This trigger shows you when it triggered. Generally, if you want to follow the backtester as closely as possible, you would only look at the ones that have traded today, but the other ones are sort of for reference, but you can certainly look at those and consider entering those as well if you chose to. Additionally, anything that has this orange AI symbol attached to it means that in addition to all of the other criteria that we've mentioned, we've also passed it through a screening layer of our artificial intelligence. That artificial intelligence used a large language model in order to find, to test, many, many different scenarios and to come up with an algorithm that would help identify more edge, more chance of winning, more likelihood of winning and winning both more and more often based off of how stock moves, how it jumps up and down, and also if it tends to move up during those jumps or down during those months, during those jumps. So the statistical term for those are skew and kurtosis, but there's a lot more into it than just the pure skew and kurtosis because we've done a lot of things to make that data useful. So the ones that have a little AI symbol by it mean not only is it active, but the skew and kurtosis data, meaning the performance of skew and kurtosis over the past 6 months or a year, are also favorable. So it's a little extra signal, a little extra indicator that this is a strong position, strong signal, and ready to jump into. So for anything that's blue means it triggered today. Then you can click on one that triggered today. This one, the AI is also favorable for this one. And you can see the skew and kurtosis settings here. This little green bar, when I click that link here, it pulls up the back test. It pulls up the market simulation. So this is using a put spread. For this ticker, there's technical conditions set. I'll go into those more. It's being this particular strategy, this fade the dip, is short a 40 delta and long the 30 delta puts, meaning you're short the put spread because the 40 delta, basically the options market is saying there's a 40% chance that the stock reaches this price by expiration. And this one has a 30% chance of reaching this second strike by expiration. That's a shorthand way of thinking about what delta means. It's what the options market, what the math of these options is saying, how likely it is that something's going to be met, that a certain option is going to end in the money. We have a lot more great information on delta, but all of that information is packed into this back test, and we'll go into a little bit more detail in a second. But this little green flag also says that the technical conditions that caused this to show up in the Today tab not only were true early in the day, but they're actually true right now as well. And so when you look at the technical conditions here, they're printed here, and you can read them that way. You can also scroll down. It says open trade when, and there's a couple special models here, the squeeze and the mammoth. You can read about those. But the technical open allows you to kind of customize the technicals. You can use what we have. You can customize your own. But these are all of the conditions that are being met. And that little green flag says these are all true. It says the stock crossed up through the 200-day moving average. The stock is above the 10-day exponential moving average, that the 20-day RSI is below 70, meaning it's not overbought. And additionally, that these AI characteristics are also active as well. You don't have to worry too much about these. Basically, it says the asymmetry, if it's above 0, it means it goes up more often than it goes down. And the tailedness means how big the jumps are. So the higher it is, the bigger the tail is. But we've set these up in a way that they work well. So these are our own proprietary technicals. You can play with them if you want to, but anytime they're set, you can feel confident that we set them to a level that makes sense. Okay, so you can log into this screen anytime you want to, and you can filter these and say, look, I only want to look at tickers that are in the largest 500 by market cap, pretty close to the S&P 500. Or you can say, I only want to look at tickers where the option prices are tight. I like things that are very tradable, that there's, there might be a dime between the bid and the ask, then you can say the best. If you're okay to have markets a little wider, 50 cents wide, etc., then you can start coming down here a little bit. 3+ is a pretty good benchmark. There's more you can read about the exact details of all of these things. So if you go to 3+, it narrows down the selection. And now when you click on one, you're going to know that you're not going to see some stock that's $1 at $5 or, 0 at 250. It's going to filter out a lot of that noise of stocks that are less liquid. Okay, so looking at these different positions, I will draw your attention to the fact that you can also, if you don't want to just log in all the time, if there's a certain strategy, like let's say you look at buy the dip or the long strangle, if you like that strategy and you want to be notified whenever one of those occurs, you can click Set Today tab alerts, and you can scroll down to any of these that you want to set. So, buy the dip, for instance. So you could say, I want all of them, or you could say, I just want the largest 500 by market cap or the NASDAQ 100, etc. So you can start by just picking a few of the strategies that you're most interested in. And then if you put your email at the top and you click save, now you're going to be emailed when these are triggered on this page so that you don't have to necessarily log in and keep refreshing the page. That you can be notified and just kind of keep an eye on your email. Okay, so I created a quick little cheat sheet here. So this is if I zoom out a little bit and you can see all of the strategies all in one. There's 14 different strategies. We keep them in the same position. We say that none are triggered yet because it can be confusing if you know that you want to look at, you love the buy the Bollinger Buy the dip, for instance. If we just remove this tile altogether, then it's confusing because you're looking for Bollinger Buy the dip and you can't find it. So we'll just say, hey, if the technical conditions haven't been true for any symbols here, then we just haven't found any yet today. So these things will stay in the same relative position when you log in. Okay, so I created a little cheat sheet here about what each one of these is, and we're going to include some more information when you click the little question mark. So you can kind of see, so this spread the sell-off is one of the more complicated strategies. It's also very powerful and interesting. It relies on, you should take a credit. You only want to put this on if you can get a credit. And it relies on the fact that the stock is moving downwards, but you're hoping it doesn't move down too much. You're okay with it to move down a little bit. Your profit actually goes up. Then you start giving your profits back and start losing money until you hit your protection. Very frequently, this one might go down. You might show that your position is in the red for a while, even if things are going great, just because of the nature of the trading. If the stock starts to go down to your short options, the short options are going to look more valuable, but you're kind of hoping it doesn't move too much more and that you can eventually pull out a nice win. We have a lot of call diagonals here where you're selling a call more out of the money that expires first, and that helps finance owning a call that's closer to the money. And so if nothing happens, then you can, you basically don't lose anything or even make a little bit of money in the near term. And if the stock moves up, a good amount, you still do well, even if it moves up quite a bit relatively fast. It has to move up quite an extreme amount very, very fast before these would turn, where that would start to really hurt you. So a lot of long call diagonals. These ones that are beginner, think are all just long calls. You can see in parentheses it says beginner. Here's a short put spread, a long strangle. We're actually going to look at one of these in more detail today. Just a straight long put. So there's a beginner is either a long call or a long put. This bearish burst is a long put. And then we have earnings diagonal, same basic, philosophy as mentioned before about the diagonal. And then these pre-earnings 3-day, 7-day, and 14-day strategies are all long calls over different time frames, and they're based on the fact that oftentimes stocks rally coming into earnings, especially if it's a good, positive earnings season so far. There could be kind of bullish momentum across the board, and also that owning them going to earnings, oftentimes it doesn't cost you as much in terms of the premium in the option because there's so much potential built into the earnings event that if you buy an option after earnings, a lot of the value is retained, and sometimes the implied volatility will actually go up even more. And so sometimes even if the stock doesn't move that much, you can still make a little profit. But these actually sell before the earnings event. We don't wait for the earnings event to happen. We actually take advantage of that bullish momentum and then we get out. These are not earnings bets. And then a short put spread. So you make money if the stock doesn't go down post earnings. And this is based off of stock having relatively not great earnings, but that they're not going to continue going down after that. So they kind of take a bad hit after earnings or a moderate hit, and then kind of the bad news is over, and then the stock starts to rally. So that's based on that phenomenon that oftentimes the bad news comes out, the stock drops, you wait a day or two when you get in, and even if the stock goes sideways, you still make money on that position. So that's kind of a quick overview of all these different strategies. Okay. So we're going to look at this long strangle. I just noticed that for Salesforce CRM, we just had a trigger on the Today tab. It's not a position that we've talked about so far. You can click the question mark to learn more, and the question mark pulls up the video as mentioned. But when you click that CRM, this is what you get, and I'll just follow along here. So this is this CRM, the Salesforce trade. And then we'll kind of dive down and look at the specific trade. Okay, so it's still active. The trade is to do a long 40 delta call and a long 40 delta put. So these are both slightly out of the money, a call and a put, using an expiration that's roughly 14 days into the future, or as close as we can get to 14 days in the future. So that's the basic strategy. When these technical conditions are met, if you click on it, you can see more details and you can see every trade that was placed historically. You can even download trades or copy the trades to the clipboard and dive into the detail. But yeah, you can see every trade and when you exited. You exit this position when you scroll down here. So this is a strangle or long. The earnings handling is we do not trade earnings. So if an earnings event happens, we will exit before the earnings, and then we'll wait 2 days after the earnings for the conditions to happen again before we enter. It's a technical open. So when I click the technical open, it says that the stock needs to cross down through the 200-day moving average. So the stock is, moving in a downward trend, and the stock is below the 10-day exponential moving average. And the exponential moving average just means you look at the data, the more recent data, and give it more weight. So it's also kind of in a long term, not doing that great, and in the short term also declining. So that might seem like a stock you wouldn't want to trade, but this is a strangle. And so you do fine if the stock goes up or if it goes down. Okay, so for Platinum members, if you're an annual member, then when you click this show options, it's actually going to show you the trades that it would take right now, the actual strikes and expirations that you would trade in order to put this trade on. And if you're not an annual member, and if you become an annual member, you actually save 17% over the course of the year. And it also helps us out for how we, rent our servers from Amazon, all that kind of stuff, license our servers. But no problem if you're not an annual member. You can click the show options. You know that you want to be as close to 14 days in the future as possible. 15 days is pretty close. And then from there, we are looking at the call delta. We want as close to 40 delta as we can. And on the put delta, we want as close to 40 delta as we can. So there we have it. So that tells us the position that we're going to put it on. This liquidity filter on the Today tab, if you don't see it right now, we are going to make some version of it available to all users. Probably just an on-off version, so not quite as much granularity, but at least probably you can just jump straight to the 3+, meaning you'll get rid of the most, illiquid names. But we do release to the Platinum users first because they're our longest lasting users and they give us great feedback and all that kind of stuff. So that was a good thing to mention. Okay. So we pull up this trade. It says that it's active. There's some information on delta here. If you click the what is delta, it's going to give you a nice deep dive on the delta. But the important thing to know is that 50 delta is at the money. The lower the delta for both calls and puts, the further out of the money it is. So calls, as the strike price gets higher, means that stock has to go, say, from 200 to 220 to 230 to 250. That delta will get lower and lower and lower as it goes further and further out of the money. And I think the simplest way to think about it is the chance that that option the stock will end up getting to that strike price by expiration. And it's nice because it factors in a lot of things about how much movement, how much volatility the market is assuming is going to be there. I know a lot of people might be used to trading something that's, say, $5 out of the money or something like that. The nice thing about Delta is if you're $5 out of the money and it's closing tomorrow, that's a very different trade than if you're $5 out of the money and it's expiring in 6 months. Delta factors both of those things, wraps it all up in one number. So there's a nice little deep dive on Delta here, as well as if you go to the Learn tab, if you look at the education, this second course, part 2, Delta and implied volatility will go. This is about a 90-minute course on these things. It's completely free to TradeMachine users, and that will do a deep dive on these topics. So if you go to Learn tab and go to education, you can really level up your options knowledge. And so we definitely encourage you to jump in there. Okay, so I typically use the Thinkorswim web front end. A lot of people use Thinkorswim. I find the web front end a little just kind of faster and easier to do simple trades if you're not trying to do real deep analysis. So if you pull up CRM, you click this little options chain icon. Now you want to find the expiration closest to 15 days in the future, or 14 days in the future, which is 15 days. You look down at the delta, you find your 40 delta, and this I did earlier today. So this changed by $5, which strike was the closest. And same thing on this side. You look for the delta. Put deltas are negative just because the way the math works, but you look to the closest 40, when you look at it from like an absolute value perspective. These give you the 2 strikes to trade. And then in the web version, you just click the ask on both, and it will pop up the order ticket. As I mentioned, for annual users, you can save a step and just click the show options. That'll pull up your order ticket. It defaulted to 10. I changed it to 5 contracts each, which gave me about a $4,000, position. I was fine. It kind of priced it when you did like this, complex order book multi-leg strategy. It actually starts it off near the mid-price execution. So I was fine with that. Sometimes with a single leg, oftentimes it'll go for like the asking price and not it'll put a limit order in, but for a pretty bad fill. I clicked review. It said it's going to cost me about $4,000, and I sent the order in, and it just got filled right away. This is a little earlier in the day. The position is actually up a little bit over the course of the day. So then the question becomes, okay, so now I put the position on, but when do I get out? And so when you scroll down in TradeMachine, let's see here if this is the right trade. Let me just pull it back up. So I'm going to click CRM again. Down here, we have the open trade when, and then we have the close trade when. So you can also set a technical close on your strategy. So you can say, hey, if it crosses back down underneath the S&P 500 or these 200-day simple moving average, that's great. This one says if the position is up 20%, then exit. So this one is trying to capture a small win, but it has a high win percent rate. So you're just kind of trying to capture, the stock is down quite a bit. You're just trying to capture a little bit of, the volatility and just take a quick exit. If you go 10 days without making that 10%, then you get out. So those are the conditions that I'm going to exit. So it cost me about $4,000 to put it on. So I'm looking to make about $800 in this position. If I can't do it within 10 days, then I get out. So that would be, I'm looking for these individual strangles to go to about 960. So what I can do is actually just click close selected, and I can set, you have to say, I don't want to set just a day. I want to say good till canceled. So it'll just stick around until I get rid of it. And I can set that to 960. I can click review and send. And all of a sudden, it's saying, okay, you'll take a credit. It lines up with my math at around $4,800. So that's the plan, is to try to make $800 sometime in the next 10 days, if not sooner, on this position. We thank you for being members of TradeMachine. Thanks for spending your hour with me, and I hope you found some things here helpful, and we'll be doing this again next week. And all the best. Have a good night, everyone.